Welcome to this explainer. Okay, let's dive right into this. Today we're looking at a completely fascinating inflection point for a company called Enovix. For years they've been working in the lab, trying to conquer what is honestly one of the greatest engineering hurdles of our modern age, creating a 100% active silicon anode battery. But as we all know, inventing something in a lab and actually manufacturing it at commercial scale, those are two entirely different games. So today we are tracking their journey of transitioning this wildly complex battery R&D into a physical commercial manufacturing reality. We'll be drawing directly from their first quarter 2026 earnings report, as well as the latest market reactions.
Here's our quick roadmap for today. We'll start with their 14-year silicon journey, pivot to real-world production, and look at their MX1 drones. Then we'll unpack their manufacturing bottleneck, and finally dive into the financials and a recent analyst downgrade.
All right, Section 1, the 14-year silicon journey.
To really grasp where Enovix is today, you have to realize this path started way back in 2012. Their absolute core goal was to tame the single most difficult battery chemistry in the world. Look at this quote from their chairman, T.J. Rogers. He says, "The lithium atom is arguably the sharpest knife in the world, which easily slices between the layers of silicon atoms in a wafer, turning a once sturdy crystal into mush." It's such a vivid analogy, isn't it? It perfectly hits the nail on the head regarding the core physical challenge they faced. For over a decade, the problem wasn't getting energy into the silicon. No, it was keeping those silicon anodes physically intact from the microscopic destruction caused by lithium atoms during charging. They literally turned the crystal into mush after just 10 cycles.
But fast forward to today, and the progress is just staggering. Currently, Enovix routinely achieves a 500 charge-discharge cycle life. Now, that matches the baseline standard that's been in place for years. But here's the hurdle. Modern smartphones demand an 800 cycle requirement. So they aren't quite there yet for phones, but they are incredibly close. In fact, they've already passed 72 out of 75 major battery specifications demanded by their toughest smartphone customer. They literally just have a couple of life cycle tests and a freezing power test left on the checklist.
Moving on to Section 2, pivoting to real-world production. Now, what's really interesting here is that as this technology finally pivots from the lab to actual devices, Enovix had to challenge some deep-seated industry norms. For years, the smartphone industry relied on a legacy test called the 0.7C test. But that test was designed for traditional graphite batteries. When you apply that same rapid discharge protocol to silicon anode cells, it artificially stresses them way beyond how anyone actually uses a smartphone in real life. So, Enovix successfully pushed leading smartphone OEMs, like Honor, to adopt a new 0.2C test. This new protocol is actually designed specifically for silicon anodes and reflects actual, real-world usage. Clearing this hurdle, getting major manufacturers to literally change their testing protocols, that was a massive victory. It removes the primary structural barrier to getting their batteries qualified for smartphones. But while smartphones might be the holy grail, they definitely aren't the only market. Just think about this number, 50,000. That's the number of smart eyewear units and prototypes Enovix expects to ship in 2026. They've already kicked off commercial production and initial shipments for a leading smart eyewear reference platform. And this is a huge deal because it absolutely validates their ability to manufacture their 100% silicon anode architecture at a true commercial scale right now.
And they're already pushing the envelope with their next generation, which is the AI2 platform. This leverages new tech to reduce material thickness and bump up the cathode voltage, delivering a massive 20% higher volumetric energy density than their previous generation. So why start with smart eyewear? Well, it requires 12 times less raw material than a cell phone battery. That means these smaller batteries run faster and with a much higher yield through Enovix's manufacturing lines. It makes smart eyewear the absolutely perfect early commercial beachhead to prove their tech works in the wild.
All right, let's move to Section 3, taking flight with MX1 drones. While smart eyewear is ramping up, their defense and industrial business is already generating some serious commercial momentum. Enovix recently launched the MX1 drone battery, and honestly, the specs are incredibly impressive. We're talking 360 watt-hours per kilogram in energy density, an extended cycle life, and a ruggedized design meant for rapid discharge. But crucially, because these are manufactured in their South Korea factory, they're fully NDAA compliant. And if you follow defense tech, you know that is a massive selling point for Western defense contractors. Plus, they aren't stopping there. They're targeting 400 watt-hours per kilogram by 2027. High-performance military and industrial drone demand is just vastly outpacing the available Western supply right now, and Enovix is perfectly positioned to step in and fill that gap. To put that into perspective, their global pipeline for products manufactured in Korea now exceeds $130 million. And looking at the breakdown, over 60% of this demand is driven purely by rapidly expanding drone applications. By leveraging their existing defense manufacturing footprint and just integrating their new silicon expertise, they've built a real revenue engine here. Section 4, the manufacturing bottleneck. Okay, so this is the real climax of their story. This is where we drop out of theoretical R&D and crash into the gritty, physical realities of a high-speed manufacturing line. Setting up an entirely new battery line is a multi-year headache. Recently, Enovix identified a major bottleneck in what they call Zone 1. Basically, the laser cutting process they were using to cut the hard cobalt oxide cathode was just way too slow and honestly far too expensive to scale economically. So what was the fix? They brought in a completely new mechanical dicing system. Now they're combining this into a hybrid laser and mechanical process. This pivot in strategy fixes that throughput bottleneck, vastly improving both the speed of the line and the overall production economics.
And we're already seeing the results of this manufacturing push pay off. Despite the bottleneck headaches in Zone 1, get this, 90%. Yields in almost all other production zones at their Fab 2 facility are now nearing or even exceeding 90%. That is a phenomenal leap forward. It's a clear indicator that their automated manufacturing line is fundamentally sound and well on its way to high-volume economics.
So, let's bring it all together in Section 5, financials and the analyst downgrade. How does all this technical progress actually translate to the balance sheet? Well, looking at the Q1 2026 financials, there are some very strong signals. Revenue jumped to $7.6 million. That beat expectations and marks a really solid 49% year-over-year increase, driven heavily by those Korean defense and industrial shipments we talked about. Their non-GAAP gross margins improved dramatically too, from 7.5% last year up to 26.3% this quarter. That makes it their sixth consecutive quarter of positive gross profit. But most importantly for a company in the scaling phase, they are sitting on a cash runway of $582.7 million. That gives them a massive cushion to execute their commercialization plan without any immediate panic.
But Wall Street is a notoriously tough crowd. While Enovix is hitting their technical milestones, the timeline has stretched out slightly. As noted by Simply Wall Street, the current consensus from Enovix's 10 analysts is for revenues of $80 million in 2026. Now, $80 million might sound great, but prior to these latest estimates, those same analysts were forecasting $100 million. So this is a clear downgrade in revenue expectations. It comes with an increase in projected losses per share, which really just tells us that the market is impatiently asking Enovix to prove their scaling timeline right now.
However, this brilliantly illustrates the broader context. Even with Wall Street tempering expectations down to $80 million, just look at the growth trajectory. Historically, Enovix grew at 68% annualized over the past 5 years. Looking forward, even the downgraded forecast represents a 117% annualized growth rate through the end of 2026. So even with a slightly delayed revenue ramp, Enovix is still forecasted to accelerate its growth significantly faster than the broader industry average of 11%. Which leaves us with a final, incredibly provocative question. Can Enovix overcome the crucible of scale manufacturing to deliver on the ultimate promise of silicon before the market's patience finally runs out? I mean, they've solved the chemistry, they've won over the customers, and they clearly have the cash. Now the entire ballgame comes down to execution on the factory floor. Thank you so much for joining me on this explainer. Keep your eyes on this space, folks. The battery revolution is literally being fought right now on the manufacturing line, and it is absolutely fascinating to watch.